David Kostin joins us here at Post 9 this morning, Goldman Sachs chief U.S. equity strategist, who has a pretty nice list of some 40-odd names who you argue have broad tariff exposure. We named some earlier today.
Yeah, Carl, this is a big question. Comes as a surprise. I think a lot of the portfolio managers with whom we engage were anticipating this threat of tariffs would end up being a cudgel and for negotiations. But we did an analysis to try and understand what the potential impact might be if the tariffs were to be sustained. And the impact basically has an impact on earnings and also on valuation. And so the earnings impact, as you indicated, probably would reduce our earnings estimates by in the range of 2 to 3% relative to our baseline. And then when we think about the valuation of the U.S. equity market, there's a impact on higher equity risk premia uncertainty, and that lowers the valuation. So the impact in aggregate between earnings and valuation would be approximately 5%. Again, that's a scenario based on the current information we have, and obviously that's a fluid situation.
Could it be offset by tax cuts?
Well, anything's possible. Tax cuts depends on how that nature of that takes place. That may not happen until later in the year. Maybe that's a 2026 story. So there's a lot of moving parts. But when we isolated the issue on tariffs, particularly, that was the impact.
So does it alter your playbook at all? Do you move your targets? What do you do?
I think one of the things that was most interesting, Carl, we just came back in the last 2 weeks. We were in Asia and we were in Europe. We met with portfolio managers in Hong Kong and Singapore and London and Tokyo, across the spectrum. And one of the things that was surprising to us and all my colleagues in the macro research area is people are more optimistic today regarding the U.S. equity market than they have been in the last decade. Even though the stock market, as you know, is up 20% annually in the last couple of years, people are more optimistic. And it has to do with this view of American exceptionalism. And what is the source of that exceptionalism is the reinvestment rate. So, Carl, if you think a couple of numbers in mind, the rest of the world, around 26% of the cash flow of companies is reinvested in their business. In the United States, it's 42%. And specifically, with respect to the Magnificent Seven, it's 56%. So the idea of a much higher reinvestment rate is the source of this exceptionalism and why investors around the world are so optimistic about the U.S. equity market.
When you look at the hit on earnings that you just spelled out, what, 5%?
Yep. About 2 to 3%, Sarah, with respect to earnings, maybe 2 to 3% impact on valuation.
Where is that coming from? Is that higher costs for companies? Is it demand destruction?
Well, when we run through the model, the different inputs that we have, it's a sort of a combination of both. Inflation is one aspect that tends to have a sort of negative impact. And then the idea of potentially less revenues if prices go up and the consumer buys less. And it could be along the margin squeeze to the extent that companies choose not to either cannot or choose not to pass that through to the customer.
I'm just asking because last time around during inflation, they passed it on to the consumer, and the consumer absorbed it pretty well. And it actually wasn't that bad for earnings.
Well, we'll see what happens in terms of the scenario. When we run through the models, it would suggest that that's a diminution. Partly because you have less GDP growth in the model of thinking about economic activity. The idea of higher tariffs would be reduction in economic activity, roughly maybe 0.5% on GDP, and that would suggest there's less revenue and also margins will be lower.
But then maybe the Fed cuts. And maybe that's good for multiples.
There's a whole variety of scenarios that one could envision in terms of the second order implications.
Have you factored in the strong dollar and what that's going to do for earnings?
Well, that is an expectation we had as a baseline anyway, that the dollar would strengthen. It has been strengthening, and we will expect it to strengthen during the balance of 2020.
But it's also hard to predict at this point. Things could just get better very quickly in terms of putting off any real trade war, or they could deteriorate markedly. I mean, are you expecting more volatility?
No, it's an excellent point in terms of the idea of a lot of scenarios could happen in terms of timing, in terms of implementation. Europe could be there as well.
Yeah, Europe could be next.
But the idea of the volatility and the opportunity set there is that, yes, we would expect volatility to go higher. And uncertainty, that's the source of the higher equity risk premia with respect to the valuation of the market.
When you were on your travels, did you find that sentiment about Europe was bottoming, as had been suggested by some in Davos?
That is definitely not the case.
Really?
You go to Europe and you go to Asia. Even in the home regions, usually there's a bit of a home country, home region bias. Only 3% of the portfolio managers in Europe expected that Europe would be an outperforming market this year. I mean, it was really a real dearth of excitement there. And it was all about the United States. And it was a function not just of the Magnificent Seven, but the idea that the U.S. companies are reinvesting so much more in their businesses compared with companies around the world.
Right. Those numbers you gave are pretty interesting. A lot of research out today. We'll be leaning on it heavily. David, thanks.
Thanks, Carl.
Good to see you. David Kostin.